The US reporting season is drawing to a close, with just under 90% of companies having reported their March quarter results. 54% of companies have been at the revenue level, while 76% of companies have been at the earnings level. This is comfortably ahead of historical averages. However, it's important to point out that there are a number of downward revisions at the beginning of the reporting season, so expectations going in were quite low. The best performing sectors were healthcare, consumer discretionary, and telecommunications, which on average reported revenue growth of around 5%. In terms of financial performance for the whole S&P 500, revenue was down just over 2% and earnings were down over 6%. This is the third quarter in a row of declining earnings and the steepest since 2009. The energy sector, which has been impacted very heavily by declining oil prices, was the main contributor, as well as the strong US dollar. Excluding these two factors, performance was a lot better, but businesses continue to rely on cost-cutting initiatives and share buybacks to offset weak revenue growth. The movement in oil prices and the US dollar will remain key drivers of performance for the rest of 2016 and will provide positive and negative implications for the various sectors within the S&P 500. One of the real standout performers this reporting season was Amazon, which surprised the market with a very strong result. The company's earnings came in 75% ahead of expectations, sending the company's share price up 12% in aftermarket trading. The company's result was driven by better than expected results from both its retail business and Amazon Web Services, its cloud computing business.